Well, we got a lot of questions as to why we think these things are going to happen. Let's just review what we were talking about on my timing model, because it's a very big advantage for us as investors to know what's optimum for us to include our start investing and where the best time to place our capital for my investors. So as you know, I've talked to Dr. Nenner for many years. Dr. Nenner's favorite line is, "I know what is going to happen. I don't necessarily know why." So today we're going to talk about what is going to happen, what's showing on our timing models, and then I'm just going to talk about some of the things that are happening that are going to confirm our timing models. So let me just go to my very first slide and let's just talk about my timing model. And of course, I've shown this many times. This is simplified, of course. We don't necessarily show you all the calculations. We'll take a look at something very shortly here that confirms this. But our timing model tells us where the corrections are going to be. And it's an uncanny ability, but these models actually tell you where to start looking for something that's going to happen. We came into the mid-course correction, and it came in, we pinpointed to the month because we just knew that this is what is going to happen. We knew that something was going to happen in this time frame, and like clockwork, within 30 days, we got the correction. We knew it was a correction in an ongoing bull market, and it was a great buying opportunity for us. It just gave us an opportunity when everyone else was getting scared. We knew it was just a correction, and that we were able to enhance our returns. Now, as we go through this, it tells us our signposts. We understand where we're going and our time frame. So we've been going up this model, and we are at the top. So we get into the topping process. It is a process. It takes a little bit of time. Now, I knew that when we got to the end of the accumulation phase and went into the explosive phase ended March 2022. I was expecting it to end very soon, and we had an event. That was the liquidity announcement from the Federal Reserve that they were going to start removing liquidity at $100 billion a month. Now, I knew on my timing model that I was expecting some kind of event to come along. Here it was. I didn't know what it was. Now I knew why this was going to happen. And that's when I represent my investors, my word and my investment advice. I quit buying for my investors. We quit putting out new capital, because we only have two things. We want to make money and not lose money. And it was no longer optimum for us to be purchasing with new capital. Now, we're still doing 1031 exchanges. So let's not get those confused. We are still moving capital from Seattle and Portland and Chicago and getting them into better markets like Florida, Texas, and Arizona. A lot of them coming here to the Phoenix metro area because it's just such a great market. That is not putting new capital. That's seasoned capital. So we quit putting in new capital. So let me go to my next slide, and let's just talk about what we saw. So this is a great work that was done by Charles Hugh Smith. This is bubble symmetry. Now, if you follow my work, and by the way, if you would like the content that we're bringing, if you like the research that I'm doing, it would be nice if you just supported us with a thumbs up and maybe a subscription, because the YouTube algorithms just love that, and it really helps for our visibility. Last week, I talked with Charles Hugh Smith. He sent us these slides. This is talking about the bubble. Now, during that interview, and if you just go to Federal Reserve electronic data, you can just see the bubble in almost all the data. It's just enormous. Trillions and trillions and trillions of dollars was inputted into the economy. And the bond bubble, because it brought interest rates down, and as interest rates go down, bonds explode to the upside. We had stocks explode, and real estate exploded. We had commodities and gold. Everything was doing well because there was plenty of fuel to fund the bubble. And if you just look on any charts, you can see the bubble. Now, here's the thing. Bubbles are not permanent. They always retrace, and you always have reversion to the mean. This is bubble symmetry work by Charles Hugh Smith. And you can see that it goes from to the left hand, and it comes down and retraces all the way to the right. There's a time frame for that, which fits into my timing model beautifully. As it goes along, you can start seeing where we should start expecting things. So let me go to the next slide. Now, we talked to Charles last week. He said that the 2008 through 2010 bubble, and of course, the bubble wasn't just in the real estate, it was in lots of other financial assets, that it had been abbreviated because the Federal Reserve had a policy response and they put in lots and lots of money, trillions of dollars. Now, there is a function to recessions, and that function is to get rid of all the malinvestment, to get rid of all the things that aren't working, to get rid of the zombie companies, just like they say that a forest fire gets rid of all the dead wood in the forest, but the forest fire is just an awful event. That's what happens in a recession. That was halted, and a new cycle started from a much higher position than it should have. So his is that we may even retrace all the way back to 2008, 2009 prices and restart that bubble from where it should. Now, this is some of his retracement work. He thinks we could have 30%, but we could have a 60% decline nationally in home prices. Now, I agree with him on 30%. I think we'd do 35% is what is my thoughts. I think here in Metro Phoenix, we could easily go back to 2020 prices, maybe 2019, because, the pendulum never stops where you think it should. Could go back to 2018. He's thinking it could go back 60% down to 2008. Well, that's a possibility. We're going to see. My timing model is just telling us what is going to happen. It's telling us that we are going to have a completing process, which I think is going on now. I think that completing process is something we see now. And I think we have a real strong possibility in the coming months that we'll start heading down onto the right side of that, and we'll start seeing lower prices. We're already starting to see a softening of the marketplace. So that's what is going to happen. Let's take a look at some of the why. So here's, again, one more chart with Charles Hugh Smith. I want to bring this to your attention. It fits beautifully into mine. We knew that, so my timing model nailed the time perfectly within 30 days. And you can see the accumulation phase. You can see the explosive phase. You can see the two tops. And what we're looking at now, and we're looking at probably 12 to 18 months, are 3 buy signals. And we think those are coming. So if you want to get involved with us, this would be a real good time. You're welcome to contact us. I'm going to put our phone number at the end. For you to contact us, you will always own these properties, but you'll be underneath our portfolio management, and we'll maximize that for you and hold your hand through it. So if you are interested in it, let us know. And let's go back to, this is the economics of what's going now. So there's always a why. We know what, but there's always a why. Now, we talked about the fact that liquidity was being withdrawn. That's how I could see that the explosive phase had come to an end. But currently, right now, I got this from Zero Hedge. The national average for our loans, single-family homes, is 7.88%. That's if you have really good credit. If you don't have such good credit, you're going to be up over 8%. This is terribly prohibitive at pricing. So either two things are going to happen. Either we're going to see home prices come down, or interest rates are going to come down. Now, these prices can be sustained if you have 2 or 3% long-term money. If you don't, then something has to give. Now, this is the why. Now, you are why with the what, and you can see where this would be a confirming model. Now, Charles Hugh Smith is using a completely different approach, and he's coming to the same conclusion as I am. Housing is going to be under pressure. And if you're purchasing, or if you're an investor, you may consider waiting. Now, that's not saying that we're not going to have great buys, because things always come to us. We have all kinds of problems. People still get themselves in trouble financially. We have, death and birth and dissolve. So all kinds of things contribute to having good deals. People get under stress, and these oftentimes give opportunities. I'm not saying that to look for them. I'm just saying that the cautionary flag is up. And in general, we're seeing a danger in my model is pointing to probably more problems. So let me go to my next slide, and we'll finish this up. Here's the other confirming model that we have, is that we're looking at some of the mortgage applications are literally at a historic level. You have to go all the way back to 1996 to see these mortgage applications. So this isn't just high interest rates. You can see that the high interest rates are having an effect, and that effect is putting it to the place where people don't want to purchase anymore. So without the people purchasing anymore, obviously, you can start seeing problems in the mortgage industry. You can see it in the escrow industry. You can see that with people doing home inspections, and you can see this in repairs, furnishings, appliances. People buy homes, they buy new furniture and carpeting and flooring and draperies, and when they don't, they stop. So this is going to have a knock-on effect all throughout the industry. So this is why I'm calling for probably a pretty tough slowdown, because they will feed on each other and cause a problem. Now, everything ends. So I'm going to fully expect that somewhere along the line, things are going to get better. You saw my three models my 3 buying points on the models. That's what we want to do. That's the what. Don't know what the why will be yet, but we'll know what it comes along. We'll know what's happening. So, and the final confirming model for ourselves is that the pending home sales have gone right along with mortgage applications. They are really at a historical low. You have to go, well, when they're historical lows, it means it's never ever happened before. It tied what happened when we locked the economy down and nothing was happening, and we've come down. And this is an actual. This isn't a simulated slowdown. This is an actual slowdown. That's really the worst in history. So it's just confirming that we have a major problem. So my timing model is going right off the charts. I think that we're going to have an absolutely outstanding opportunity to properties very, very shortly. In the meantime, if you have any questions, you're welcome to give us a call. We answer the phone. We do consultations. We're more than happy to talk to you, your spouse, your financial advisors, see how we can work with you. And we're going to have an absolutely outstanding opportunity to be purchasing these properties. We'll do the calculations for you and let you know our opinion, whether we think it's a good deal or not a good deal. In the meantime, I expect you to be very, very out there, and my very best to you.